What's up, everyone? It's Market Wizard here. This is the next episode of the educative series of the Learn How to Trade. Today, we're going to talk about one of the most important foundations in trading, which is the price trends. If you don't understand trend structure, you will constantly trade against the market, get chopped in ranges, and misinterpret momentum. So before you learn any advanced concepts, you must understand this properly. Let's break it down in the simplest way possible. I'm going to start with the uptrend. So the uptrend is when the trend is going generally moving higher. But here's the key. An uptrend is not just price going up randomly. It is defined by structure, specifically higher highs and higher lows. What does that mean? When the price makes a high, then it pulls back, but the pullback does not break the previous low. So this is a higher low. And then it pushes to a new high, which is higher than the previous one. So this is a higher high, and this is a higher low. So that sequence creates a bullish structure. Buyers are in control, demand is absorbing supply, and the momentum is shifting upwards. The most important thing to understand is that when you're in an uptrend, the expectation is continuation to the upside until the structure breaks. So instead of trying to short every green candle, your bias should align with the direction of the structure and try to long the dips. Trade with the flow, not against it. Let's see, when does the bullish structure breaks? It's when the downtrend begins. So a downtrend is the opposite of the uptrend. Price is generally moving lower. It is defined by lower lows and lower highs. So when the price makes a low, then it pulls back, but the pullback fails to break the previous high. So this is a lower high, and then it pushes to a new lower low when the new low is lower than the previous one. This is the bearish market structure. Sellers are in control and the supply is overwhelming demand. In a downtrend, the expectation is continuation to the downside until the structure shifts. And instead of trying to long the dips, it's easier to short the bounce because that's where the market structure is heading. And then we also have the ranging environment. Now this is the part most traders misunderstand. The sideways or ranging market is when the price moves between a defined high, which is our range highs, and then a defined low, which is our range lows, with no clear direction. It creates equal highs, equal lows, but you also have failed breakouts on both sides, and of course a choppy price action. Why it is important to learn how to trade this environment is that 80% of the time markets are actually ranging, specifically on higher time frames. The trends are explosive but temporary when the ranges are normal and frequent. That's why breakout traders struggle. They think every consolidation is the start of a new trend, but most breakouts fail because the market is simply distributing or accumulating inside the range. So when you're in a range, you buy support and you sell resistance, and you keep doing this until it is no longer in a range. That sounds simple, but most of the traders fail to execute this very simple environment. Why does it matter? Because everything in trading builds on trend understanding. liquidity sweeps behave differently in trend versus a range. Support and resistance act differently in trending conditions. Even indicators behave differently depending on regime. If you trade counter trend without a valid structural shift, you are fighting momentum. So if you try to trade inside a tight range, you will get chopped. So you'll have to keep the ranging mentality when you're in a range environment. And don't try to trade as if you are in an uptrend or a downtrend, because you will get chopped. And I would like to show you a few real examples of how these trends work. I'll have Solana as an example here because it's a very clean example of how the trends work. So let's start with this one. We have a low here, we have a high, then a higher low, higher high, higher low, and so on until the trend shifts. And then we start the downtrend where we have a lower low, lower high, lower low, lower high, and so on. And then we start ranging. What does the price do? It just goes to range lows, range highs, range lows, range highs, until the range is broken and we continue the price trend that was trading before the range, which was, in this case, the downtrend. So then we continued the downtrend here, and now we have a new range. So what should you expect here? You should expect the range until it is broken. If it's going to be to the upside, you should expect a higher high here and a higher low, and this will confirm the trend shift. So something like this. If it's a trend continuation, which means that it's going to continue the downtrend, it will continue to do lower lows, lower highs, and so on, until it starts ranging again. That's all for today. If you found this valuable, like the video, subscribe, and comment what you want me to explain next. This is Market Wizard. See you in the next episode. Bye-bye.